Right. Good afternoon, friends. I hope you guys are well. Yeah, this was a phenomenal week. We didn't trade a lot. That was really not necessary with the amount of fluctuations that we had going on in the market. As you guys know, I mean, one of the big things about how we trade is most often for longer duration trades. So we really need positions to actually be con or trends to be consistent for at least a couple of days in order for us to be able to get swing trades. And the reason is because most underlyings don't have zero DTE. So it's, just the indexes, things like SPY and the Qs that track the indexes that give you those zero DTE, same day expiration trades. But this week, we closed out the week, depending on how you trade the systematics. We closed out this week at between 25 and $28,000. You can see that our systematics just were gangbusters this week. I mean, that's really the only, I don't even know how else to explain it. I mean, um, Fridays settle, butterflies just cleaned up. That was by itself already almost a 5K win. Also down here, the settlement butterfly, 1800. Then again, you have all three butterflies closing out for again near $2,500. We closed out some trades, or we managed some trades that had short positions that were expiring. So you can see, Datadog had a short position November the 21st that was closing. So the OPEX Friday, similar to Sound and also Pan W. So a lot of the trades that we had today were more about taking profits off the table and managing trades to make sure that they're really secure. Sometimes you guys know that when we're in positions like let's say like a calendar spread, and I can just show you that quickly. When we're in positions similar to, let's say, a calendar call spread, and okay, let's just make it for APLD. And let's say we have a really strong conviction that by December 19th, APLD will be back at the 25. So we sell our short at the 25 since our expectation is that it's going to go like around December 19th, that OPEX, APLD will be around the 25. But let's say, for example, we decide to set this up, and here you can see that the expiration of the short and the long are like back to back. But let's say we had a much stronger conviction that APLD was going to squeeze all the way into the end of the year. We could adjust that long call to give it a lot more time. And because our expectation is that by December 19th, that APLD could actually get to that 25 strike, we want our short position to expire around that time. It doesn't make sense to add duration to the short position, even though it will allow us to take in more credit, because what you want is with the calendar spread is to have a price target in mind and then for the price to get to it or near it so you can manage that short. Your two decisions would be that you just take it off or let it expire out the money, or you can extend it like week over week if the trade hasn't actually reached your pin price yet. So this gives us a little bit of flexibility. So we have about four expirations between our short expiration and our long expiration. And as long as APLD isn't above the 25, we can just keep rolling out that short for some extra credit, or we can allow it to expire out the money, because let's say that APLD is at 24 and now our long position can just get naked and get deeper in the money, which will allow us to make more money. So as you can see, as APLD approaches that 20, 25, 26 strike for December 19th, since that is the first expiration, the calculator will always give you the profit loss on um, on the expiration of whatever is expiring first. So it doesn't necessarily have to be the short position. You could be in some structure that has two long positions, but whatever the first expiration date is, that's how it's going to calculate the entire picture, the entire P&L for you. So yeah, so here we had a lot of positions where the short was expiring out the money, and we could choose to just leave those long calls naked, whether that was Datadog, whether that was PanW, whether that was, any of those trades. And we did decide to roll out many of those short positions to take in some extra credit because of the fact that the long wasn't yet in the money. So we can go back and look at some of those. So the sad thing is because we've closed out these trades, we can't actually see the P&L graph anymore. But here you can see our Apple trade was, I decided to close that. You can see that was a 210% return. That is not the cumulative return. We actually made a lot more money on this trade because we were rolling out that short leg almost every month. Now, because of the fact that Apple was in the money, and that I just ended up deciding to just close the entire structure. And part of the reason is because one of the things that I was waiting for Apple to do was to give us this pullback. Because as you always see with our with these trades, is that it has this tent formation. And so when price goes beyond you and you know that you're going to get a return into the tent, you can maximize profits. So when Apple was actually like way above us, we were still making money, but we weren't at the 210%. We were at maybe 170%. But by taking advantage of this pullback on Apple towards the 260, then we saw this pop. And I basically said, at this point, we can just close this strategy. But another person might have really liked this and said, no, I want to roll out the short to December 19th and take in some extra credit and maybe move this 265 back to 270 or 275 to just allow this long position to be more naked, to get deeper in the money, and to give it a higher delta position. So let's just run through some of our trades here. Oops. There. Yeah. So we can go up to the 17th, which was the Monday. And you'll see that we were also adjusting a bunch of trades. So we had a number of positions on snow, and the main thing was to just take in a lot more credit by rolling out the shorts since snow is still below 280 and 300. So that's what we did. So we just took in $585 and $280 of credit per contract that the person was in. Same thing with IBM. We did have a 350 calendar. Still, the price of IBM is below us. So again, we moved it and we actually shifted the entire structure down. And this is one of the things that I really like about calendar spreads, which I think that not enough people consider, is that, when you have a really weak market like we do right now, but like something's not just like the market's not just like dropping straight down to give us that V-shaped recovery. It's really like digesting and then moving down and digesting and moving down. And so when you have these like slow bleeds, if you are in a structure like something like this, but let's actually see what it looks like on IBM, right? Let's just set one up, right? So let's just say that we like IBM for the end of year to the 350. So we actually set up this 350 calendar spread. So it's a calendar spread because the strike prices are the same, but the expirations are different, hence calendar. If it was going to be a diagonal spread, then both the strike price of the long and the short would be different, and the expiration dates would be different. But anyways, let's set this trade up and let's pretend this is a trade that we super duper love and we believe in. But because of the fact that like right now, price has obviously dropped a bit back on IBM and it's kind of digesting here around the 300, you might feel like that 350 strike is just a little bit too far out the money. And so the good thing is that if you move down the short strike, you are going to take in some credit, even if you don't change the expiration date. And then you can take that credit from the short position and then move it into the long position and move that long position down. And the reality is that this is how everyone should be trading options. This is actually the point of trading options, is that you should not be just using options as a proxy for shares. That is what a lot of people do in order to reduce the cost of entry, but that's actually not what options were really created for. It was a way to be both long and short the market without being long and short shares, because you cannot be long and short shares at the same time. So this actually gave you a way to participate in the upside, protect yourself to the downside, even make money to the downside while your shares were giving you that exposure to the long side. This is what options was really created for. And I do encourage people to learn. You don't have to learn with me. You don't have to learn with Trade Speakeasy. You can learn it from whatever, but this is how you should learn to trade options. If you are trading options and not most only trading options as a partner to your shares. So anyhow, so basically what we did is that we had this 350 calendar here. It's showing obviously 340, and we just decided to shift that trade down to the 320 as we felt this was a much better placement for where IBM was likely to go on its next leg up, in spite of the fact that we currently have a very weak market. So yeah, so that was, that's just a side note. But yeah, so we managed a couple of trades. We did manage snow only by rolling out the shorts. We still believe strongly in the position of the longs. And then also with IBM, we actually rolled the entire structure down. We did add some hedges this week because we were expecting on the Wednesday and the Friday, Gamma was showing us downside action. So we did add an iron butterfly down at our pin price, which was 65.75. And we were able to get almost, actually, we were able to get $1,200 at the time that I posted this. I just wanted people to put in their stop loss so that they were able to make, like if they couldn't watch, that they were able to get out to make sure that they at least left with $870 per contract. The max loss on this trade was actually about $1,500, and the max potential profit was near about, I think, five or $6,000. So it was like a 1 to 6 risk reward. And so it was worth trying to stay in to squeeze out the most possible from the trade. And that way you don't have to take as many contracts. With just one or two contracts, you could have easily made $2,500, which if you were down on your shares, which most people probably were last week, that just gives you a little bit of cushion to decide, do you want to hold on to cash and wait for some bottoms to be formed, or are you dollar cost averaging? And so you can like move the $2,500 from this hedge into your share, but you have a lot of options. HIMS has been annoying. It has just continued to drop. It has not found a bottom yet. We are in a short straddle, and the benefit of a short straddle is that because again, you are both long and short the market, you hedge a lot of the volatility. And so what we've done is we actually just added more time onto our contract, moved it out to the January 16th, took in a massive credit. So you can see that these short straddles bring in a massive amount of money. So it gives you a really wide range of movement for the stock, for you to be able to make some money. The point is not to look for maximum profit. We're not looking to make $1,600 per straddle. What you're trying to do is just consistently rinse and repeat this strategy against your shares in order to force the underlying to fund your DCA, or dollar cost averaging, into the stock over the long run. So let's see. So NVIDIA, we were expecting a pop up to somewhere between the 190 and 200, which we achieved. And we were able to make a nice little profit on our positions. I did signal to the group that, like NVIDIA normally does, it gets a nice pop on earnings and then it gets a pullback. So whoever wanted to, exit their trade, they were more than welcome to do it. You can see this is actually a custom trade. And so what that means is that we are both in downside positions and upside positions, and we combine them. So again, a lot of people with options, they just do leaps, like they're just long, and they just say, okay, I'm going to get a lot of time, and at some point I am likely to be right. I don't have to be right on my timing on the entry. I don't have to be right on A or B or C or D. So it's basically it's not a bad way to trade. I don't want to make leaps sound like they're not a good way to trade. People make millions of dollars just trading leaps. So um, I'm not like bashing that process, but I do think that, learning how to, again, trade both sides of the position, you can significantly increase your returns and significantly decrease your output. So it didn't cost us, I mean, the amount of cash we had to put up to be able to participate in this trade was just relatively nothing because our downside position is decaying with time and our upside position is benefiting from the move up. So I'm not going to show you the details. Those who are in the Discord, they know what this position is and they can open it up from the link themselves, but it does allow you to kind of get an idea of how we trade here at the Trade Speakeasy. So then we did manage some Uber positions. Again, that was just to move the legs around a little bit to take in some extra credit as our shorts were expiring um, last Friday, and we wanted to add more credit to that position. Yeah, so snow, you can see we were up almost 100%. The short was decaying. I basically told people that they can, just take this off because we are seeing quite a bit of weakness in the market. So, okay, yes, it doesn't have, usually we like to target at least 100% return on the trade and then at least to close half and then leave another half open so that it is now a completely risk-free trade. However, in this situation, there just wasn't, I mean, we were green and there was no reason to just hang around and lose all of that on a very weak market. So here, Pan W, we're up 430%. That's this trade is up way more than the $2,560. It is up closer to about $3,800 because we actually have been rolling that short leg out week over week over week. And each time not week over week, month over month. So we are able to take in a significant amount of credit. And of course, on earnings, our expectation, because Pan W has a history of failing on earnings, even though Pan W was way above us and we actually weren't seeing a 430% return, it was quite a bit lower. We did see a nice pop on our position. And so I did signal to people if they were done kind of rolling and rolling and rolling these legs out, they could just close up this position and then we could wait to set up and like some brand new positions on Pan W going out in time. Sound, same thing. That was up 210%. Again, this is only showing a $78 return, but we have been for many days now, many months now, rolling out that short position. So we're up actually quite a bit more, but this is a nice way for people to make money as they hold their shares. Um, so Iran, same thing. It's up 81%. This is actually, we've managed this position multiple times. And that decayed now 81%. So I did signal to people they can just get out. This is a bull put spread, so a put credit spread that we sold against some of our other positions while we were waiting for Iran to actually come back into our range to give us that pop in our other calendar spreads. And then Apple, we've been in this position forever. I think I already talked about Apple. That was actually one of the first ones I talked about. So now I have just closed that. So again, a very successful week this week. Part of the reason that we did so well this week was because our midday iron butterflies and 130 iron butterflies just did spectacularly well. A key reason is because you can see the credits were just flaming hot. So normally, volatility is not this high. So usually we're not seeing $3,000 credits for a position that is literally only 4 hours long, but and very, very quickly these things were decaying for significant amounts. So even people who were only taking the scalps and not participating in the end of day structures, they still could have, if they just held on to the trade based on the rules and didn't just have their profit target set, they could have easily like quadrupled their normal returns because of the structuring. Here again, you can see $3,800. Um, Here you can see $4,200. So these are massive credits. And Here you can see $5,700. I mean, this is just was a completely abnormal week. You can all see I mean, we just hit Mariah Carey and Tony Braxton every single day this week. For those that are in the group, you know um, what our signals mean. But yeah, so this is a great week for everyone and for all of the trades, especially the systematic trades. And that's something that I want to reiterate. One of the reasons that we trade systematic trades plus discretionary trades is because you always want your portfolio to be diversified. And a lot of our systematic trades are based on rules that are that we trade regardless of market environment, whether it's bearish, whether it's bullish, whether it's consolidation. These are time-based patterns that we're trading. And so one of the things is that there are really great charts that are setting up for really great moves, and we want to participate in those. But those are all discretionary. It means we have to look at the charts and then we have to make a decision. And then each day we're in the trade or each week, we need to make a decision if it's worth staying in the trade. And so there's a lot of decision making in the process. The good thing about systematic trades is that by making it systematic, there are a lot fewer decisions, a lot less interaction the individual should have with their trades if the rules show up and they just participate. Now, like as we saw the couple weeks back, because of everything that was going on with Trump, there was a lot more erratic behavior in the price action. And so the systematic trades did have difficulty giving us those gangbuster returns. And so, if somebody was only trading systematics, they could have left the week very, very discouraged. But the discretionary trades performed very, very well. So, but then like this last week, we didn't add many new trades because the market hasn't hit a bottom yet. So we're not ready to get long. And because the market is just bouncing down, it's not just making clean moves down. It's not like we can get into like naked long puts and just ride this stuff down, because then we need to be opening and closing a lot of trades at exact moments in the day. And for people who can't be, like hunting their positions like that because they work or have kids or whatever, they don't want to be trading with that kind of anxiety. So we understand that. So in the end, this is why, it's good to have a balance, because this last week we didn't open a lot of discretionary trades. We were mostly managing trades, and we closed a couple of really great trades that have been baking in the background for some months. But you could have easily participated in any of the systematic trades and you would have been making money. Now, one of the things I do want to leave you with before I close up this weekly roundup is, as I discussed, there is a potential that we could consistently get negative news going into the end of the year, or maybe into Thanksgiving and post Thanksgiving, that will get us to a more significant downside move. And if that happens, you want to be ready to participate in getting shares or participate in moving into more longer duration trades. But you have to be prepared for that. So please take time on the weekend to really look at what trades, what underlyings you really like, and which ones you'd want to participate in if there is a bottom that develops before we get a potential V-shape recovery like we've seen on all of the downside activities. So That's something for you to think about because you don't want to get ready, you want to be ready. So take some time this weekend, work on that. And yeah, I hope to see you guys tomorrow in the Discord, and I will talk to y'all later. Bye for now.